Good morning. The meditation I selected comes from Proverb 13:11. I like the way the New Living Translation reads. Wealth from get-rich-quick schemes quickly disappears. Wealth from hard work grows over time. In this verse, Solomon observes the difference between wealth acquired suddenly and wealth gained slowly but honestly. The implication of this proverb involves money that is brought in greedily or through questionable means, and that which is simply gained instantly. Those who dishonestly seek wealth by taking advantage of others or by engaging in schemes can expect their wealth to disappear just as quickly as it arrived. Let's pray. Father God, thank you for giving us this opportunity to learn more about how to be better stewards of our finances through this workshop. Help us to discern honest business dealings and those that are meant to harm us. Give us the wisdom we need to honor you with our money. In Jesus' name, amen.
Amen.
Amen. And thank you so much for that awesome meditation. And Member Tanya, could you please share the PowerPoint agenda or the run of show PowerPoint, please?
Yes, ma'am.
Thank you.
Are you able to see my screen okay?
Yes, we can see it. Thank you. All right, so we are going to go ahead and get right into it. We have a reading of the bio for our first speaker. And once the bio is read, we'll move on to that speaker. And then we have a little bit of fun right after. Member Sonia, could you please go ahead? Oh, I'm so sorry. I skipped past the greetings. Let me back up. My apologies. We have greetings from our chapter president first, and then we'll begin our bio.
Good morning.
Good morning.
All right. Good morning. My name is LaShawn Jacobs, and I serve as the president of Alpha Kappa Alpha Sorority Incorporated. We were the first chapter established in the Dallas-Fort Worth area on June 6, 1929. Our chapter is the second largest in the South Central region and one of the largest in the nation. We are proud to sponsor three undergraduate chapters on the campuses of the University of North Texas, Texas A&M University, and Southern Methodist, Texas A&M University of Commerce, and Southern Methodist University. Since its chartering, Alpha Xi Omega chapter has been an integral part of the Dallas community in the delivery of programs and educational activities that fulfill our mission. Our theme is transforming the community with AKAs, ambitious and knowledgeable, amazing service. And that service continues today, assisting and educating the community with programs about building economic wealth is a national initiative and information that everyone can benefit from. We are very honored that you have chosen to wake up early and spend your time with us this morning. Welcome on behalf of the Alpha Xi Omega chapter. Thank you.
Thank you so much, Madam President. And now we will move into our first speaker's bio, which will be read by member Sonia Bracken.
Good morning. Thank you, Member Jasmine. Vincent Wilson is from Cambridge, Maryland. He graduated from East Texas State University, now known as Texas A&M at Commerce. Mr. Wilson is a member of Omega Psi Phi Fraternity Incorporated. He has a degree in finance and has been in the financial services industry for 30 years. He has participated in several Alpha Kappa Alpha chapter financial programs over the years. Most recently in 2019 at an Alpha Xi Omega chapter financial workshop event, he conducted a workshop on investments where he received rave reviews from the participants. He enjoys helping clients invest their money for growth and or income. Please welcome Mr. Vincent Wilson.
Thank you, Sonia. That was words I've never heard before. It was very nice. I can share my screen now. Is that how we're doing this? And that, okay. Okay, here we go. I appreciate the opportunity you guys give me for presenting today. I really do. And this is my contact information, just in case anybody wants to make a phone call or shoot me an email. But why invest in stocks? Let me see if I can go through this real quick for you guys.
Mr.
I don't
Wilson,
want to
just a
bore you
moment.
to death.
Mr.
But
Wilson,
yes.
we're not seeing your screen.
can't
Just a minute, let
see
me
you.
make sure
Yeah,
you're
we
able.
can see your screen.
Oh, it's not? Oh, okay. Let me see here. Share screen. And this technology is something else, I'll tell you. Oh, how's that?
It's coming up. There we go. Yeah, we see why you invest in stocks.
Yes, there we go. Okay, all right, that's my contact information, just in case somebody has an email or shoot me an email or phone call. So why we want to invest in stocks? Let me go through this real quick for you guys. It's real simple how stocks are designed, you know, to basically help build wealth for you. And you take ownership in part of a company when you own stocks. And one of the things is that patience is involved when you're investing in the market, when you're investing in stocks. This is one of the quotes from Warren Buffett, one of the world-known investors out there. And as Ms. Tanya said in the beginning, growth is made over time with investing. So you have to be patient. Now here's an ad from a bank. It says a 5-year CD of 1%. We want you to be patient, but we don't want you to be this patient. Because if you take that 1% and you follow what's called the rule of 72, and that takes the amount of time it takes to double your money. So if we take the number 72 divided by that 1%, your money is going to double every 72 years. Again, we want you to be patient, but we don't want you to be that patient. We don't have that kind of time. So we want to be able to invest in something that's going to give us some better returns. So therefore, we want to put money in stocks to give us that return that we're looking for. And so, go back. So we have annual interest rate or rates of returns. Normally, the market has been averaging between 8 to 10%, somewhere in that range. And so investors' money with patience has been doubling roughly every 9, 10 years. When you're more aggressive, you're taking on more risk. So now you're looking for a higher return. So even if you're looking for a 14% return and you're trying to get your money to double every 5 years, remember you are taking on additional risk normal than a normal investor. But that also beats putting money in a CD, savings account for long term. You know, you want to put money in a savings account for that quick ATM withdrawal, something maybe to do with you need to get some tires or something like that, a tire, to go withdraw $300 or $400. But when you're talking $4,000 or $5,000 and you're trying to, you know, build some wealth, you want to put it in something that's going to give you a better interest rate, even if you're going to put it in something that's a little safer for that emergency, because you want to get a better return than what the savings account is going to give you at the bank. So you're looking for like a money market or even a bond fund that's paying a little higher than what your bank is going to give you. But long term, you want to be in your typical assets that's going to grow your wealth, your real estate, your stocks or whatnot, not a savings account for long term. Right. And so we don't have a crystal ball. Nobody has a crystal ball, but sometimes we get those questions to where people are going to do what they want to do. And they ask questions about, well, what if this happens? I'm going to pull out. If this happens, I'm going to wait. That lets me know that they may have a crystal ball on their desk or something at home to you know, figure out what they're going to do financially. But since we don't have a crystal ball, what happens is that their behavior is reducing their rate of return long term. And what I mean by that is that most investors who underperform in investments normally sell their stocks or their investments when the market is declining. And that particular investment behavior is counter to building wealth long term. Because what we want to do is we want to be able to buy these assets as they are declining. We want to be able to buy those assets at cheaper prices and be able to sell them down the road for higher prices. So the object is to buy low, sell high. Well, part of buying low is taking advantage of situations like currently the market is not really performing well, but we want to be able to take advantage of prices while they're low so we can help build our wealth down the road, because eventually the market doesn't stay this way forever. It just doesn't. So what happens is that we take, for instance, JCPenney has a sale. Everybody flocks to this particular sale, 25% off, 75% off, whatnot. I mean, I'm guilty of that myself, but we also have to be able to look at financial assets or real estate assets. When these assets are on sale, we need to do the same thing. Start accumulating these particular assets, because like I said, they don't stay at these levels forever. It looks bad, economy looks bad, and even in the news, it looks bad financially. And so that tends to help make us do different things with our money instead of just accumulating assets. Right? So again, example is that when we had the pandemic in March of 2020, everybody panicked. They didn't know what to do. They didn't know what was going to happen. They didn't know what the outcome was going to be. So the market declined that third or fourth week in March, and everybody was selling. Everybody was selling. But the problem is again, being patient with your investment and also taking advantage of lower prices tends to work out for us long term. Here's an example. This was March 23rd, 2020. If we look here, well, the Dow Jones, this is Dow Jones that closed at 21,636, March 23rd, 2020. This is when the pandemic announced and everybody was saying, oh, we're going home. Everybody's going home, we're closing schools and all of that, ABC stuff. And the market ended up closing because of the unknown. Didn't know what was going to happen. But I'll tell you, yesterday, the Dow closed at 32,000. Yesterday, right? And also at the end of 2020, we still had a positive year. So those who panicked and got out and waited and said they're going to wait until things get better missed out on having a positive year, because not only do you have to come up with an exit strategy, you have to come back up with an entry strategy as well to figure out where you're going to be, where you're going to place your money when this thing turns around. And eventually it does. It's just a matter of time, patience when you're investing with stocks, because they don't automatically always go up. As another example, this was part of the Obama administration, where we had the financial meltdown in September of 2008, right? The meltdown was, things are going bad. Lehman Brothers is going out of business. A lot of financial mess was happening in the economy and in the world and here in the United States. That's when they started having to lower interest rates, which is why we had low interest rates for the past, it's been a while, almost a decade, I believe. We had low interest rates, and that helped to spark financial assets, real estate. It helped to increase assets over time. And if we look at this, the Dow closed at 11,388 on 9/15/2008. Again, we closed yesterday at 32,800. So that's where you have to be patient, because again, it doesn't stay here forever. It doesn't stay here forever. As this has shown, we've had a bull market for the past, 10 years? somewhere around there. So we have to be patient when we're investing in stocks. If you're looking for individual stocks, you want to look for good quality companies that have good revenues, good products in the pipeline, not too much debt, a good net margin, net profit margin, a good gross margin. Just having quality companies in your portfolio tends to help you wait out the bad economic situations that happens here. And that's where mutual funds also come in. Because what a mutual fund is, basically it's a portfolio of stocks or bonds, or stocks and bonds. And basically you're diversified into so many different industries. So you can have some tech, you can have some energy, you can have some home building, you can have food and beverage. All of those particular industries are mixed together in a portfolio for the benefit of the investor. And one thing that's beautiful about having a mutual fund is that if things start to go bad in any particular company or even any particular industry, what the portfolio managers are able to do is to sell that company, obtain that cash, and move it into something that's more profitable. They're not going to sit around and hold an Enron all the way to 0%. So it's for the benefit of the shareholders that portfolio managers make those decisions for us, because they're wanting us to make money as well. And the only way to do that is to be invested in profitable companies. A lot of investors look for that overnight quick fix. I'm going to invest in this particular penny stock. Well, there's a reason it's a penny. It's cheap. Yes, it's cheap, but there are problems with it. Financially. It could be management problems or whatnot. So you want to steer clear from those particular investments only because of the risk. You know, if you're looking at a penny stock, reason it's a penny stock, there's something wrong, it may go to 0. And as an investor, you don't want to do that. You don't want to watch an investment and your hard-earned money all of a sudden go to 0. So what mutual funds do, they don't invest in the penny stocks, they invest in the quality companies that we have available on all 3 markets, all 3 stock exchanges, NASDAQ, S&P 500, and Dow Jones. And so as long-term investors, that's where we want to basically tend to put our money and be patient with it. And so, again, you don't want to be in something 5 years getting 1%. That does us no good for long term. We want to be able to grow our money as fast as possible and take as little risk as possible. And it is to our advantage to look at some stocks, maybe some stocks and stock mutual funds, or even mutual funds that hold stocks and bonds. You get that mixture to where now you're getting interest on your money as well as growth from your stocks in the portfolio. And so that's my reason for why we have to invest in stocks. And I will take questions. I told you it wasn't going to be long. I didn't want to bore you to death, but I'll take some questions if there are any, or however you want to do this, Jasmine.
Okay. I know Mr. Wilson will have to hop off before the end of the presentation. So if you have a question for him, please put that question in the chat at this time, and we will answer those questions for about the next 5 minutes, and then we'll move on to our next speaker.
Thank you, Member Jasmine. Mr. Wilson, will you stop sharing your screen, please, and we can get the, there we go.
Okay.
Thank you.
I see there's a hand up, Danielle Williams. If you have a question for him, could you please put that question in?
I'm
the chat?
placing it in the chat now.
Oh, okay, okay. Thank you. And thank you for that presentation, Mr. Wilson. I'm not that well versed on stocks, so that was really very helpful for me. So because I've always wondered why stocks, it seems so risky. So thank you. All right. Is member Stephanie on?
Hello, I am.
Oh, okay. You want to take the first question?
Sure.
Okay, thanks.
So we do have a two-part question. And first we have how to get started in investing or any kind of brokerage firms.
Yes, that's basically what you would basically do. Open up an account at a brokerage firm, and basically deposit funds and start to select what investments you want to have in your account, whether it's going to be individual stocks or mutual funds. Then you have to decide what kind of mutual funds you want to have, or that you consider growth and income, or just income. So there's a wide range of different type of mutual funds you can choose from, or you just want to have some individual bonds to where you might want to invest in Walmart bonds or Microsoft or something like that. So there's so many different options available to the investor to help grow your funds for long term. But yeah, opening up a brokerage firm, a brokerage company, a brokerage account would be the right choice. Or you can invest directly with the mutual fund itself. So that's always an option.
And what are some resources for researching stocks?
Just basically you can go online. You got CNBC.com, you got Motley Fool, you have investing.com, Bloomberg.com. Basically, when you want to pull up a website like that, you basically look for the company you're looking for. If it's publicly traded, you could find the financials on it. You could look at the income statement on it. You could look at the balance sheet, how much debt it has, how much cash on hand it has, and basically figure out if this is the company for you, and look at possibly another company in the industry if it's not. If you're looking for something in technology, then being in Microsoft may not be the thing you want, but then there may be the next software company that's available in the industry, and you can pull that up as well. So yeah, there's several different sites that you can look at to pull up different companies and check out the balance sheets and the income statement.
And then a question from Karen. Do you look at emerging technology in making portfolio decisions, or can your clients inquire about investing in specific stock? For instance, electronic batteries, cars, etc.
You can. A lot of those companies are basically, a lot of those particular companies are basically umbrella under larger companies. Like GE owns some type of battery company, not GE, General Motors owns some type of battery companies for their EVs or whatnot. But there are a lot of companies coming along with technology in that particular industry. And it's something to look forward to down the road. But yeah, you could do research on those particular companies you want to invest in. And again, if they have to be publicly traded for you to be able to invest in them, if they're privately owned, then that won't be able to happen. But if they're publicly traded, you can invest in those particular companies. Again, looking at the financials on them, what the balance sheet is on them, because they may be on the cusp of producing so many batteries. We're using this particular industry as an example, but they may be on the cusp of producing so many different batteries for EV cars. But they could be in some type of financial situation to where they may be, down the road looking to be bought out because they may not be able to sustain what they're doing if their financials aren't in place. So looking at the income statement and looking at the balance sheet will give you an indication of how well this particular company is doing.
Okay, and then we have a question from Jamaya. How do one go about diversifying one's portfolio?
Well, you want to be able to, well, first, you can also invest in a mutual fund that's already diversified for you. It's already created. And we're just investing in a portfolio with portfolio managers, making those decisions, what goes in, what comes out of the portfolio. But if you're going to do it individually with individual stocks, you want to make sure you're investing in different industries. Again, you don't want to be in, have all of your assets in technology per se, or you want to have some tech, you may want to have some energy, you may want to have some automobile, you may want to have some food and beverage. That's how you basically diversify your portfolio, by being in several different industries at one time. When you're investing in individual companies, you may not want to have 1,000 companies. You may want to have maybe 4 or 5, but they're diversified into 4 or 5 different industries. That way you're concentrated on some of the best companies. I hope that was answered.
Hello.
And-
The next question is from Tanya. Question from Isaiah. Oh, what app do you recommend to buy and or sell stock? I'm sorry, it's from Isa.
Well, personally, I don't recommend apps because when you're talking, one thing with apps, you got to be on top of the app at all times when you're buying particular companies. And most investors, if they're putting their $100,000 into a retirement account or a regular investment account, they don't use an app. So most of the apps are designed in trying to capture the investor with the $5, $10 investment. But now, if you have a particular brokerage account that's already set up to where you have that amount in there, and if that brokerage account has an app, you can basically look at your portfolio that way. But I don't recommend like the Robinhoods or whatever. That's just me. And it's up to the individual to make that determination. But I see that sometimes, the apps can crash. You may not be able to get in the app, as opposed to being able to call your broker or investment advisor to make that particular decision. You want to invest X amount of dollars, whether he or she can be able to take that trade and do that trade for you.
The next question is from Olivia. When you have a retirement plan where your investments are managed by a portfolio manager, how often do you suggest reviewing the chosen investments, and what are some indicators that my portfolio should be adjusted?
Yeah. Well, you should be able to receive a quarterly statement to make sure your investments are doing what they're supposed to do. And if you're going to make some adjustments, it's got to be based on whether that particular company is going to continue to perform the way it's performing. So say, for instance, if you're in a mutual fund that's all of a sudden, you have a growth and income fund, and you're all of a sudden not getting income, but you're getting a little growth. Well, that objective has changed on that fund. But if you invested in that particular fund for growth and income, and you're not getting the income like you were, it's time to make that change because the objective of the fund changed. That's one way of looking at it, but you want to be able to review your quarterly statement to see if you're on track, to see if that particular investment is performing the way it's supposed to. Again, it's not going to go straight up. So sometimes like we're experiencing right now with the market, a lot of quarterly statements are coming through the mailboxes in red, with red on, because the companies aren't performing well, or the mutual funds are not performing well. Part of this particular downside in the markets, but that doesn't mean they're still not on track. It means that we're having some type of financial hiccup, which we go through on certain periods of times of the business cycle, but you have to be patient. And that's part of the investment process. But again, if a particular company is not making money, all of a sudden they were making money 2 quarters ago, but now all of a sudden they have a net income loss, then that's probably a good time to change that as well, because now the company's not making any money and the foreseeable future may not be as good in that particular company.
All right, we have time for one more, and then we will need to move on to our next speaker. I think there's one more in the chat.
Yes, the last question is actually from me. How do you feel about investment clubs?
Oh, they're good if you can find good quality people to work it out with, because, you know, over the years, I've seen that clubs come and go. Part of the reason is because you have some members, they want to invest in XYZ. Some members want to invest in ABC, and then you get conflict to where somebody wants to pull out because we didn't invest in ABC. But, you know, it was voted on in the club that we would be investing in ABC. But then you also have members who all of a sudden have financial issues where they have to pull out. So that hurts the club as well. Clubs were very popular in the early 90s. Really haven't heard too much about them here lately, but it's a good way for people to get together, do some research, and basically pool their assets together, almost like a mutual fund, pool their assets together and buy those particular individual companies that they want to invest in. But then again, the only problem is that, you know, you have those particular personalities that go in different directions. And so you want to be careful with that as well. So you want to have like-minded people involved in the club.
Thank you so much, Vincent, for taking time to address those questions. And now we are going to move on to our next speaker. And I believe we have his bio ready. Member Guinevere, are you ready?
Yes.
Jasmine, before
Yes.
we
Yes.
listen, I'm sorry, but yeah, I have to hop off. I've got something I gotta get to right quick. But I appreciate you guys letting me have this opportunity for coming on. I want to make sure I say that to you guys. I really do. I know I've done several workshops with some chapters, but I want to make sure I'm always appreciative for having the opportunity.
Awesome. Thank you. And I will be following up with you after this as well. Okay.
Sounds good. Sounds
All
good.
right.
Enjoy.
Thank you. Have a good rest of your day.
Thank you. You guys too.
Thanks. All right. Member Guinevere, whenever you're ready, you can go ahead.
Thank you, Member Jasmine. It gives me great pleasure to introduce to you Ojari O.J. Hathaway. Ojari's mission statement and life goal can be summed up in one sentence: helping people become the best versions of themselves through well thought out financial strategies. He helps clients accept the power to change themselves and create an independent life. Building long-term relationships with his clients is at the heart of OJ's business. He prides himself in the ability to establish positive and lasting relationships through proactive outreach and assistance. He empowers his clients to make smart, well-informed financial decisions that are knowledge-based, not trendy. This allows them to take charge of their future to accomplish dreams, goals, and aspirations. As an inspiring leader in the Black community, Ojari provides ongoing guidance and financial education to close the racial wealth gap and create economic prosperity for the African Americans. He thrives when helping others grow professionally. He is currently a prospective district manager where he continues to build his practice while also coaching and mentoring the next generation of financial professionals to career success. Leveraging his experience in leadership roles, he brings core strengths to his current financial position, including budget analysts, customer service, and team building. Over the years, OJ has received several leadership awards for high performance, maximizing profitability, and reducing employee turnover. As a member of the Exclusive Retirement Benefits Group, RBG, OJ focuses on providing a holistic and consultative planning approach with emphasis on retirement planning. He aims to help clients achieve their short and long-term goals, as well as establish a clear strategy to retire with financial dignity. He focuses on serving high net worth families, physicians, healthcare professionals in private practices, small business owners, nonprofit organizations, educators, and administrators. OJ graduated from Langston University and received an MBA from Webster University. He is a member of the Alpha Phi Alpha Fraternity Incorporated. I present to you OJ.
Thank you so much. I really appreciate that. And before we get started today, I want to first thank you, Jasmine, for allowing me to be here on this Saturday morning. I know many people today could be somewhere else, but what this tells me is that you are looking for information to become the best version of yourself and improve yourself through getting this additional knowledge with finances. Sorry about that. That's the Amazon guy. You know how that be. In addition, I also want to take the opportunity to thank Brandy Mickens, who's also my business partner, and who also introduced me to this career as well, and has been a long-running chapter partner who now just recently moved to Ohio. So without further ado, let's go ahead and get this thing started. I know we're limited on time, but I'm going to try to make and add as much value as we can within the next 20 minutes. So let's see, we'll just go right here. All right, give me a second.
So Jory, I have your PowerPoint up if you want me to share it.
Okay, let me just go ahead and quit my, sorry about that.
Okay.
All right. All right, great. Let's go to the next slide, please. The table of contents, please.
Okay.
All right, thank you so much. So what we're going to cover today is a little bit about who should invest in a mutual fund. What exactly is a mutual fund? When should I start and how do I get started? So Mr. Vincent Wilson gave a lot of great points and information. I'm just going to continue to expound upon mutual fund. Next slide, please. All right, there we go. So real quick story. So I had a client come to who actually is a daughter of one of your chapter members. She came to me a couple of months ago and said, OJ, I have some money. I've been saving money in the bank account, but I really want to get started on investing. I just have no idea where to get started. Where should I go? And I told her, I asked her a couple of questions, and this may resonate with a lot of people on this virtual Zoom meeting. I asked her, do you have the time, the temperament, the expertise to battle daily with the market through its emotional ups and downs, different moves and swings? She told me no. I said, well, it sounds to me, you may need a professional manager. That professional manager is what we call a mutual fund. So a mutual fund gives you a couple of benefits. First, diversification. We don't want to put all our eggs in one basket. I say diversification and I like to break concepts down, make them simple and easy to understand. Think of it like buying a bag of Skittles, different flavors. You got purple, yellow, green, red, orange. Some of us may love the purple, which is my personal flavor, but those different flavors represent different companies. So a mutual fund allows you to get access to high-performing companies, mid-sized performing companies, small companies, and package it together. Let me give you an example. As of today or Friday close, Apple stock was $146.71 per share. Microsoft is $249.22 per share. So if we want to properly diversify a portfolio and have enough holdings, sometimes our dollars may not meet that amount that we need to make sure that our investments are going to be able to handle the emotions of the market. That's why diversification is so important and why we invest in a mutual fund. Next, low minimum investment. This could be exciting, especially for those who have young children on the line. You can get into a mutual fund for as low as $1. That's right, $1. So using that example, I started my daughter's first mutual fund at age 4. And we're going to get into a little bit about that with the time value of money. But mutual fund allows you to get into invest with high quality companies at low cost. Flexibility. So you're just not limited to one company. You can be invested into several different industries, all under one package. Think of a mutual fund like when I go to Walmart, I can get almost anything I want. That's what a mutual fund is to investing. Most importantly, professional management. Again, the market is always emotional. We get excited when the market is going up, like in April of 2022, when the market returned 22%. But then we get a little concerned, just a little concerned when the market goes down, like we recently experienced last year where the market went down negative 21%. So a good professional money manager, for example, are companies that you're going to be very familiar with. Next slide, please. Slide after that. So professional money management, what is a mutual fund? Some of these are brands you may be familiar with. You may have seen them in your 401k, such as Fidelity, BlackRock, Capital Group, or better yet known as American Funds, Goldman Sachs. These are the professional money managers who hire analysts, research development people, portfolio managers, that within the mutual fund itself, it shifts or changes the type of companies or the amount of companies when the economy changes. Some mutual funds, which when we talk about costs, such as an index fund, they just stay static. They say, we're gonna just buy the top 500 companies in the US, and whatever the market does, it does. I saw in the chat someone asked a question about tech or emerging markets. You have specialization funds. Fun fact, there are more mutual funds than there are Taco Bells in the US. Yes, there's a total of 28,000 different mutual fund companies. Which company should you go with? Well, pick a company that is reputable and that has a good track record. But working with a financial professional, they can really lead you to the pathway on what is a good professional money manager that I should invest my hard-earned money. Next slide, please. All right, so there's a different flavor for everybody. Now, some people may want to be aggressive, try to achieve as much growth as possible. So they're going to be on the higher end far as the risk taker. Those type of mutual funds are aggressive growth funds, moderate plus funds. Now, if you're getting a little bit in the middle where I want some growth, but I don't want to be all the way to the end, they're going to be more in the middle called moderate growth companies, moderate growth funds, balanced funds where you have 50% equities or stock companies or stock funds, or 50% bond funds, which bonds is basically you are having debt. So when we own a bond fund or an individual bond, we have someone paying us interest because they're taking out, companies are taking out debt. Then you have conservative funds. Main goal is to get us a little bit incremental growth, but we don't want to take a lot of excessive risk. And the importance of understanding your risk tolerance comes back to, what is your overall financial goal? Where do you see yourself? What do you want your money to do for you? Once we understand the goals, then we can start developing the plan and deciding what is the right mutual fund platform for you. Next slide, please. All right, so many people here are already invested in mutual funds. For example, most private companies invest into mutual funds through their 401k plan. If you have children and you're investing into their college, you may have a 5 to 9 college savings program, which is also called a target date fund. Some may, as Mr. Wilson described, have opened up an individual brokerage account. Others may have different package products, such as a variable annuity, ETF, exchange traded fund. So a variable annuity is another form of a mutual fund with insurance protection. And they do something very sweet. The number one demographic, fastest growing demographic in the country is people growing to age 100. And their number one fear is running out of money too soon. So variable annuities produce a stream of income that you cannot outlive, that is meant to supplement your income. Finally, ETFs. ETFs quack like a stock, bark like a stock, meaning you can buy, sell, the price changes on a daily basis, on an hourly basis, minute by minute, but they're packaged like a mutual fund. Next slide, please. All right, so we mentioned where we already have found mutual funds. Mutual funds do have taxable impacts. So a lot of people don't realize when we grow our money, when we're investing into stocks, bonds, mutual funds, ETFs, etc., depending on what that wrapper looks like, as the analogy that I gave you, bag of Skittles, there's a wrapper around, it may be around it, wrapper may not be around it. That creates taxable impact. So be aware of also the impact that your investments can have on your money. For example, most retirement plans, they're wrapped in a 401k. 401k is basically a IRS tax code that says we're going to give you pre-tax benefits. We're going to defer the interest earned, but when you pull it out, it's taxable. Non-qualified annuities, you put money in from your bank account. It grows tax deferred, meaning we are not paying taxes on the growth, but only the interest that grew is where we're paying taxes. Tax exempt investments, such as your 529 plan, municipal bonds, they have a tax-free element. So it's also important to understand, I'm investing in stocks, I'm investing in bonds, I'm investing in mutual funds, ETFs. How would that impact my taxes? Because if you pull money out at the wrong time, it could be really scary. That's code for IRS. And you may have a taxable bill. That taxable bill sometimes, while we're in tax season, could be coming in the form of a 1099. So it's important to understand what I'm investing in, but how is my money being invested? Next slide, please. All right, when should I start? So I hear this countless of time from a lot of people. You know, the best time to start is today. So if the challenge for everyone is, if you're not currently investing, now is the right time. However, there's a time that gives you the best result. Next slide, please. All right, so taking a look at this slide right here. Albert Einstein said compound interest is the most powerful force in the universe. If we're looking at a person that is age 25, and in this example, let's assume they're earning a 7% return. Historically, the market returns between 6 to 8% since 1970. And the market has historically only been down for more than 2 quarters 6 times. So there's a high probability you're going to get that 7%, if not more. But if we started at age 25 with $189 contribution in our mutual fund, that contribution, and we continue to make that contribution for the next 15 years, which we invested a total of $90,905. Look at this look at this compounding interest over that time. The earnings with a 7% return on that first line is $409,095 for a total value of $500,000. That's $500,000. $500,000. My daughter today is 10. This is why I started her at age 4. So if we took that same time from age 4, that's 36 years, And she started, by the time she's my age, I'm 43, she'll be a millionaire. This is the power of compound interest. Now, what do we use this money for? This money is used to supplement, again, a financial goal. So when we look at $500,000 for those who may be nearing retirement, what that will produce for each person on this call is $21,500 for the next 25 to 30 years. That's not including your pension plan, Social Security, or other savings. This is supplemental income, assuming we're only drawing out just the interest. That's why today is the best time to get started. Next slide, please. All right. Again, historically, stocks, bonds, mutual funds have always outperformed money in the bank account. So what this little graph shows is at the top blue one, if we are investing in stocks, and we did it since 1926 to 2021, that person with just $1, that money would have accrued to $56,034. This is why I'm so passionate about when we're talking about Black financial empowerment, economic development, and growth. Knowledge is our power, but taking action and being proactive on that knowledge is what changes families, changes legacies. And if anyone needs some of these slides afterwards, I'd be happy to email them to you as well. Next slide, please. All right, I mentioned earlier, one of the places where people were introduced to mutual funds is in their 401k retirement plan. So your 401k gives you limited options, but the best benefit of that mutual fund working in concert with your 401k is the tax benefits. So 401k plans, 403b plans, 457 plans offer you pre-tax benefits and tax-deferred growth. This allows you to be able to save more for less. Let me give you an example. If we're in a 20% tax bracket and we're investing $100 in our mutual fund, really it's $80 coming out of our paycheck. So this is how we can save more money. If we really want $100 coming out of our paycheck, you can put away $120. This will allow you to be able to buy more shares over a long period of time in your mutual fund, which gets you to your ultimate goal of making sure you reach your goal to supplement your income. Next slide, please. So this is an example right here. Initial investment of $100,000, because we are not paying taxes on that initial dollars, you can see how, depending on where you at on your timeline, how this money can compound and grow along with interest. Because we're not paying that 22-25% taxes, depending on what your tax bracket is. Next slide, please. Finally, college saving costs. They're exuberant. I help many clients each and every day to come up with strategies on how can we supplement or reduce that debt that my child may face when they're coming into college. One of the best gifts you can give your child is a college savings plan. In addition, a lot of people are unaware, but others can invest into that college savings plan too, which is done with a target-based fund mutual fund. When we say target, what happens is we're saying my child is going to college in the next 12 years. So the mutual fund is going to position its investments as if someone has 12 years to reach a goal. So it's going to be a little bit more growth oriented than a person that may have 5 years left to go. And it automatically, meaning you take a hands-off approach, shifts the portfolio so you don't have to do any of the work. That's one of the benefits of mutual funds, as I stated earlier. If you don't have the time, temperament, or expertise to professionally manage a portfolio, mutual funds do the work for you. And our overall goal that we're trying to achieve is outpace inflation. This is why compound interest is so important. And mutual funds is one of the best tools that you can use to make sure that you're addressing that concern. Next slide, please. So how do we get started? Saw that in the chat question as well, too. So next slide. So oftentimes what we see is, I don't have a lot of money, or there's something that has come up. Well, what we have to understand is we have to make our finances a priority. And so it can be, again, as I stated, you can start a mutual fund as little as $1. You want to definitely, again, understand where your money is going to be positioned. If you do a brokerage account and it's not wrapped, and let's say a Roth IRA wrapper or an IRA wrapper or 529 wrapper, the interest earned could potentially be taxable. One of the opportunities with mutual funds is you don't control when that fund manager sells the funds. So when the market is down, that fund manager is getting rid of bad companies or underperforming companies. That could create a taxable event. Your retirement plan wrappers or 529 wrappers protect you from that taxable event. If it's not wrapped, you could potentially receive a taxable event. So you just want to be aware, what are my goals? What is the purpose that I want how I want my money to work? So the key though is just getting started. Final slide, please. All right. You definitely want to at least just look at your portfolio at least once a year, annually. You don't have to look at a mutual fund on a daily basis. This is a little bit different than stocks. Stocks, you may look at your stock portfolio on a daily basis, mainly because you have less diversification in your stock portfolio. Again, you're managing the trades. You're managing when it goes up, when it goes down, sideways. You own the stock and the actions that happen with stocks. Mutual funds, you're hiring someone to do that for you. That's where you pay that cost, those fees. I like to say the cost. Everything has a cost. Everything that's advertised, no fees. There's a cost. That's how they do them commercials. So review your portfolio on at least an annual basis. Start inquiring. Just learn the basics. I like to say investing is the one place where when there is a sale, people run away from the sale. It's just like shopping. I love going to Macy's because Macy's have that 60% red tag. And if you're responsible with your credit, they'll give you an extra 15, 20% in addition to. That allowed me to buy 3 or 4 ties or a jacket. And then I know, and we all know in this line, Macy's price is going to go back to being regular. So when is the best time to shop at Macy's? When they have the sale. That's exactly the best time to be in the market. So right now is a great time because we're in a bear. Bear basically means the market is down. We have in a sale. It's Kmart Blue Light Special. Get in. Understand your investing goals. Oftentimes, people want to get into investing is good, but let's define and make sure that our money has purpose. Is it retirement, college savings, saving for that new house? Is it, I just want to grow my money so I can go on that vacation to the Dominican? Whatever your goals are, everything starts by setting goals, having a vision, and making sure you have purpose for your money. That will determine what is the right investment for me to use to get to where I want to be. And then update your strategy. As your life change, your strategy is going to change. When I was 25, I wanted to be aggressive, give me the most highest return. I'm willing to take the most risk. But I had, at that time, 40 years to go. Now I'm about 24 years left before I retire. So my investment style has changed. So it's important to understand when you have major life changes, make sure your investment strategy with your mutual fund is changing along with it. So I try to be as quick as possible. I don't know if we have time for questions, but again, want to thank you for your time. And if you ever want to touch bases with me, I'm happy to schedule a free consultation. Back to you, Jasmine.
Thank you so much, Mr. Hathaway. Can you still hear me?
Yes,
Yes.
yes, Member Jasmine.
Okay, thank you. So we are a little bit over time. However, if anyone has questions, are they able to just reach out to you directly with those questions? Mr. Hathaway?
Yes, and
Okay.
I'll put my information in the chat.
Okay, awesome. Thank you so much. We do have our survey for today's event. Remember, Stephanie is about to place the link in the chat. And this is just a survey to see what your thoughts were on the event itself and what type of future events you would like to see. So thank you all for joining us. We do have one more person on our agenda, and that is our chapter vice president, Rosemary Bolden.
Good morning, participants. It's a good day to be with you. We want to be good stewards of our hard-earned dollars. We want to grow wealth for our children and their children. Thanks, Mr. Wilson and Mr. Hathaway, for sharing knowledge and information we can use prudently to obtain personal goals set. We feel economically empowered. To the committee, you are wise, wonderful, and amazing to have these presenters here today. You've earned a grade of A. We value and applaud success. Now, go forward and oversee your money well and invest it wisely.
I can't believe I
Thank
left
you.
all my pens. All my pens.
All right, Madam President, we can hear you, Madam President. You're not on.
Can you hear me? You can't hear me?
I apologize.
Yes, we can hear you.
Okay. But go forth and invest your money wisely is what I just said. We've received some great information today that we can use to grow our wealth and ensure that our children and their children's their children have a wealthier life than we did.
Thank you so much. Thank you so much. And Mr. Hathaway, thank you again for your presentation. I will also be following up with you after this, just so I can explain what our committee has coming for you. So thank you so much. And thank you everyone for attending. Please be on the lookout for our next event, which will be happening in June, and we will be covering real estate. We're going into the real estate market, so please be on the lookout for our future events. Thank you all and have a great rest of your Saturday.
Thank you.
Thank you.
Thank you.
Thank you.
Great. That was a great workshop. Thank you so much.
Thank you.
Good job.
Thank you. And thank you, Tanya, for all of your technology assistance today.
You're welcome. I'm going to go ahead and end the meeting now.
Okay, thank you.